In a world where regulations grow more complex by the day, compliance alone is no longer enough. What organizations need today are RegTech solutions, powered by deep consulting expertise, to navigate complexity with confidence. Built on real-world consulting experience, Cygnus GRC Suite from the House of Crowe, one of the world's top 10 consulting firms, is a reliable RegTech solution that helps organizations navigate complexity with confidence. Cygnus Aura, transforming internal audits through intelligent automation. Cygnus Regulus, enabling regulatory audit readiness. Cygnus Nexus, proactive risk management for informed decision-making. Cygnus Vigilus, complete oversight through real-time transaction monitoring. Cygnus Scan, AML, and sanctions screening to prevent financial crime. Cygnus Vault, intelligent and secure regulatory document management. Cygnus Identia, smart KYC, and onboarding for seamless compliance. In today's regulatory landscape, compliance is not optional. With Cygnus GRC Suite, organizations stay compliant, resilient, and future-ready.
So good morning, everyone. I think we can start the session now.
Good morning.
Morning.
Yes. So myself is Vinay. I'm the head of distribution, and I am also being joined. I have my colleagues from QIC UAE also in the call. On behalf of QIC, I'm delighted to welcome all our broker partners to this webinar, which we are jointly organizing with Crowe Middle East. So today's topic, Middle East conflict and insurance market outlook, we believe is both timely and highly relevant, given the evolving geopolitical landscape and its direct impact on risk, pricing, and client expectations across our industry. The past few weeks have reminded us how unpredictable it can be. Yet, they have also highlighted something equally important, the remarkable resilience of UAE. Under the visionary leadership of our rulers, UAE continues to demonstrate stability, preparedness, and unwavering commitment to safeguarding people, business, and wider economy. Their ability to lead from the front, especially during challenging times, sets a strong foundation for all of us operating in the financial and insurance sectors. As partners, your role in supporting clients through uncertainty is invaluable. So today's session is designed to equip you with insights that will help you to navigate evolving risk, understand market shift, and continue delivering trusted guidance to our clients. So thank you once again for your partnership and for being here with us. We hope you find this session insightful and engaging. Before we begin, I would like to invite our compliance manager, Ms. Nitya, to say a few words about our co-organizers, Crowe Middle East. Thank you.
Hi, good morning, everyone. I'm Nitya Arvind, heading compliance for the UAE division of QIC. So we at QIC are delighted to partner with Crowe to organize this session on the much talked about subject, the Middle East conflict and the insurance market outlook. So we hope this session is insightful and will deepen our understanding on how the Middle East conflict is impacting the global insurance sector. On behalf of QIC and Crowe, I would like to extend our thanks and appreciation to each one of you for your active participation. Just to briefly talk about Crowe UAE is a part of Crowe Global, one of the top 10 accounting networks worldwide. Crowe has over 40 years of experience in the UAE and offers a comprehensive range of services, including audit, tax, advisory, risk, and technology solutions. Crowe UAE has also offered specialized consulting services backed by deep industry expertise. So with this introduction, I hand over the session to Crowe, and thank you for the participation.
Thank you so much, Mr. Vinay and Ms. Nitya. And once again, welcome to this webinar. Thank you for joining all the team members. First of all, I would like to thank the QIC management and Mr. Vinay and Nitya for providing us this opportunity to associate with the QIC in this organizing this webinar. As we navigate through these challenging times, I hope this session will help us better understand the current situation, the challenges ahead, and the opportunities that may emerge. Okay, today's session will be led by Mr. Piyush Das, and supported by Mr. Tommy. I would like to give a brief introduction about our speakers today. Mr. Piyush Das is our director of Crowe UAE Academy and partner of GRC Advisory Division. He is a seasoned banking professional with more than 35 years of experience. In his career with the State Bank of India, where he led treasury and risk management functions across both domestic and international markets. He has also served as a senior lecturer at the Emirates Institute of Banking and Financial Studies. His professional credentials include the Certified Compliance Manager, CCM, CAMPS, CFCS, and Sanctions Compliance Specialist certifications. And also we have Mr. Tommy today. Mr. Tommy is a veteran insurance professional with more than 40 years of experience across India and Middle East. He has served as the acting CEO of Al Raji Insurance in Saudi Arabia and as the Chief Operating Officer of Arabian Scandinavian Insurance. Throughout his career, he has held several senior leadership roles in prominent insurance organizations in the region. He is a fellow of Chartered Insurance Institute, London, and a fellow of the Insurance Institute of India. So with this, I am just handing over to Mr. Piyush Das to start the session. Over to you, sir. Thank you so much.
Thank you. Thank you, Manoj. Thank you, Vinay. Thank you, Nitya. Thank you, QIC, for this opportunity to allow us to present this webinar. My name is Piyush Das, and I'm being joined by Mr. Tommy, who's an insurance expert. You know, lots have happened in the last few days, and this webinar is appropriate to understand the complexity of the conflict itself and, you know, its impact on the insurance market. There is a saying, no insurance, no shipping, right? So we'll just look into the complexities. And at appropriate times, my colleague, Mr. Tommy, will intervene and give you further clarifications. So, ladies and gentlemen, warm welcome to this session on the webinar, Middle East Conflict and the Insurance Market Outlook. So the highlights of this webinar will be, we'll try to explain the Middle East conflict as we understand it, why the Strait of Hormuz matters to insurers, what are the reinsurance risks, what is the level of financial strength of insurers and reinsurers, which of the reinsurance lines are most exposed, how risks can be mitigated, and what is the outlook for the insurance market. And I'd like to state that if any of you have any questions during the course of this webinar, you're free to type out your question on the chat box. We will be more than glad to answer. So please feel free to ask your questions, ladies and gentlemen. So, the Middle East conflict explained. Joint US-Israeli strikes, dubbed Operation Epic Fury, was launched on Iran since February 28, 26, and reportedly killed more than 1,000 people. And of course, it triggered a wave of Iranian retaliatory attacks across the regions. Sadly, Iran's supreme leader, Ayatollah Ali Khamenei, and dozens of senior Iranian officials have been killed in the strikes and leaving a power vacuum in Tehran. Trump administration has called openly for a regime change. This spiraling conflict endangered millions of lives across the Middle East and left tens and thousands of foreign citizens stranded and at risk of being caught in the violence in the region. Trump characterized the attack as defensive, suggested it was intended to eliminate imminent threats from Iran. Israel described it as a preemptive strike at neutralizing anticipated missile strike across attack from Iran. US officials have described the offensive as aimed at crippling Iran's ballistic missile infrastructure and preventing Iran from obtaining a nuclear weapon. But Iran has maintained it was not looking to develop a nuclear weapon, although United Nations nuclear watchdog says Iran has enriched uranium beyond civilian energy needs. After bombing 3 nuclear facilities last June 2025, Trump also claimed the US had cleaned up, obliterated Iran's nuclear program. Immediately after the strikes, Trump called the Iranian people to take over their government. The strike came also weeks after Trump had promised to rescue Iranian protesters in January 2026. There was widespread protests in Iran, in the capital, in January 2026. US and Iran have long been politically adversaries right after 1979 Iranian Revolution, which established the Islamic Republic. Even then, Washington and Tehran did engage in ongoing nuclear negotiations when the US and Israel carried out its strikes. The talks resumed in early February 2026 after being stalled since June 2025, when Israel attacked Iran and US joined Israeli strikes on Iranian nuclear sites. There were reports of limited but notable progress between the US and Iranian negotiators who met in Oman on February 6th and Geneva on February 26 and 27, just a day before the strike. The strike happened on February 28 this year. The ongoing attacks obviously have hardened Iran's stance towards the US and may have shattered any hopes of diplomatic agreement around Iran's nuclear program. Iran responded with a swathe of retaliatory attacks on military installations across the region, hitting Israel, United Arab Emirates, Qatar, Bahrain, Kuwait, Saudi Arabia in initial attacks over the weekend. Yes, Iran shifted strategy since last June 2025 toward a more aggressive use of regional missiles, drone attacks, although it's constrained by its degraded capabilities and fear of escalating war with the US. Immediately after the first wave of American and Israeli attacks in Iran, world leaders urged restraint, and institutions like United Nations, European Union called for de-escalation. After Iran, Tehran targeted US bases, civilian sites across the region, the GCC, which includes UAE, Bahrain, Saudi Arabia, Oman, Qatar, and Kuwait, convened an emergency meeting to condemn Iran's actions and reserved their legitimate right to respond. I just want to now, show you where the Strait of Hormuz is. This is the whole insurance market is worried about. This is the Strait of Hormuz. Now, ladies and gentlemen, why this is important? And we'll just have a, because through this, Oil flows to China, India, other Asian countries, Europe, Americas, and Africa. Such an important strait. And, this is all about the Strait of Hormuz. This is how, look at how there are no ships passing through. This is one of the pictures, satellite pictures that were taken. So the Strait of Hormuz is a slim maritime corridor between Iran to the north and Oman and the United Arab Emirates to the south. It connects the Persian Gulf to the Arabian Sea. And basically, it connects to the global markets. At its narrowest point, the strait is just 21 nautical miles wide. That means every tanker passing through must travel through the territorial waters of Iran or Oman. There is no alternate sea route, and roughly 20 million barrels of oil flow through the strait each day. Around 20% of the world's LNG moves through Hormuz. In 2025 alone, energy trade passing through the corridor, roughly $600 billion annually, and 3,000 ships transiting each month. And all of them must be insured. The cargo, hull, everything must be insured. Can you imagine the kind of impact it's going to have? Traffic through the normally busy straits faded away in the first few days of the conflict as Iran declared the strait closed, attacked some of the ships that attempted the route. Closure of the strait affects major ports belonging to Iraq, Kuwait, Saudi Arabia, UAE, as well as Iran itself. For several of these countries, strait is the primary route through which oil reaches global markets. And the closure of the Strait of Hormuz resulted in crude oil prices jumping above $115 per ton, which was unprecedented. Overall, maritime traffic through the strait dropped by over 70% since closure. Strait closure has a cascading effect on industry. Iraq, a major oil producer, is having to shut down its production in some of its largest oil fields because they are not able to export it through the Strait of Hormuz and nowhere to store their oil. However, the question to ask is, can Iran legally close down the Strait of Hormuz? Under international law, no. As per the UN Convention on the Law of Sea, called UN Clause, ships have the right to move continuously, quickly through the straits used for international navigation, even when those waters technically fall between the country's territorial sea. Treaty is explicit on this point. Article 44 of UN clause says that countries bordering such strait shall not hamper the transit passage, and the right cannot be suspended by anyone. All this raises an obvious question. How does a country close a waterway when it cannot, under international law, close the waterway? Unlike a canal, an open ocean cannot be simply shut. In practice, closing a strait means making passage so dangerous or economically risky that commercial shipping stops moving through. And there are several ways Iran could do that. They could mine the area. They could use drones to attack the ships passing through. They could harass the ships and seize the ships because legally they cannot stop the strait. However, the bigger effect is, and that is why all of you are involved, The most powerful lever may not involve weapons at all. Because if the insurance industry determines the waterway has become too dangerous, they will refuse to cover ships traveling through it. And without insurance, vessels cannot secure financing, cargo, or crews. At that point, waterways the Strait of Hormuz may not be physically blocked, but traffic collapses anyway. No insurance, no shipping, ladies and gentlemen. So, in other words, the Strait of Hormuz is rarely actually closed, but rather economically closed when risk markets fear accomplish what navies might otherwise attempt. A commander in the Iranian's Revolutionary Guard Corps said on Monday that the strait was closed and that any vessel attempting to pass the waterway would be set ablaze. At least 5 tankers have been damaged, 2 personnel killed, and about 150 ships stranded around the strait. The tankers are clustered in open waters of the coasts of the major Gulf oil producers, including Iran, Saudi Arabia, LNG giant Qatar, according to ship tracking data. And I will not, bore you with what kind of projectiles have been hit. I'll just move on. This is the Strait of Hormuz, and globally, this is where it is. Okay, what are the marine insurance developments? As a result of these incidents, marine insurers are cancelling war risk coverage for vessels, and the overall cost of shipping oil from the region is set to increase. Insurance companies, including Guard, Schooled, North Standard, the London P&I Club, and the American Club, said cancellation of war risk cover would take effect from March 5th, according to notices dated March 1st on their website. These cancellation notices mean shipping companies with vessels in the region will have to seek new insurance cover, obviously at higher cost. So, as a result of this fast-moving situation, each underwriter is invariably increasing the rates, in some instances for vessels passing through the Strait of Hormuz, even declining to offer terms right now. War risk premiums have risen to as high as 1% of the value of the ship in the past 48 hours, from 0.2% last week. And industry sources said hundreds of thousands of dollars in costs for every shipment. If a tanker is worth 100 million, war risk premium for a single voyage would jump to 1 million from 200,000. That's the kind of impact. War insurance market is, facing a de facto close of the Strait of Hormuz, and primarily around the perception of threat than actual blockade. Costs of shipping oil from Middle East to Asia, already at a 6-year high amid the escalating US-Iran tensions and attacks of ships, is set to even rise further as widening Iran conflict deters ship owners from sending vessels to the region. War risk insurance is critical because it covers losses caused by war and terrorism, which are explicitly excluded from standard marine aviation and property policies. So, all ocean-going commercial ships do not sail without insurance. Port authorities, charterers, banks, regulators all view adequate cover as essential, making marine insurance a central pillar of global shipping. The strait could be reopened if conflict reaches a ceasefire or if there's a visible US-led multinational presence to escort or to protect the shipping. And, there is, suggestion that US President Donald Trump announced that US government will offer insurance to ships in the Gulf, and also that US military will accompany ships through the Hormuz if necessary. The United States Development Finance Corporation, DFC, is to provide at a very reasonable price risk insurance and guarantees for financial security of all maritime trade, especially energy, traveling through the Gulf. Trump added that discounted risk insurance will be available to all shipping lanes. If necessary, United States Navy will begin escorting tankers through the Strait of Hormuz as soon as possible. And I'm told this has already started. No matter what, United States will ensure the free flow of energy to the world. So what are the types of marine insurance? Hull and marine insurance, this is just to clarify, cargo insurance, marine liability insurance to third parties, freight insurance, this is regarding loss of business, and protection and indemnity insurance. So standard cargo insurance covers transit risks like theft, fire, and accident. It explicitly excludes perils like war, terrorism, and piracy. War risk insurance acts as a specialized, separate, added policy designed to fill this critical gap covering damages from weapons of war, strikes, and political unrest. Now, what are the reinsurance risks? The rapidly escalating conflict is generating significant insured and uninsured losses across multiple sectors, with further disruption to global trade, transport, energy markets if hostilities persist or widen. As physical damage accumulates and economic disruption deepens, insurers and reinsurers are turning to policy wordings. Standard commercial property insurance policies generally exclude damage or losses directly or indirectly caused by war, invasion, acts of foreign enemies, hostilities, whether war be declared or not, military or usurped power, and related perils. This broad exclusion is widely incorporated into insurance policies worldwide due to reinsurers' insistence. Political violence policies provide coverage for property damage directly caused by specific perils purchased. The meaning of each political violence peril is expressly defined in each PV policy. They are named peril policies, so the burden of proving that a loss is caused by insured peril lies upon the insured. PV policies list many exclusions, and losses caused by perils not purchased will be excluded. Early reports from the Middle East suggest that many insureds bought only terrorism or lower-level civil unrest cover, potentially leaving them uninsured for war-related losses. Where there are gaps in coverage, large sums at stake, disputes are likely to arise. Another area is business interruption and non-damage losses. Although physical damage to insured is an obvious source of complaints, conflict is also generating widespread business interruption or business continuity losses unaccompanied by There's no physical damage, but businesses interrupted. Airspace closures, port shutdowns, supply chain disruption, government restrictions are affecting airline, shipping interest, energy-dependent industries. Many insured will find such losses fall outside the scope of cover due to war exclusion, absence of non-damage interruption extensions, or narrow prevention of access clauses. This results in significant economic losses, and these may remain uninsured, although there are substantial insurance programs, a point that will come as an unwelcome surprise to many policyholders. So better coverage of business interruption for non-damage losses must be covered. Aggregation, event definitions, and reinsurance exposure. One of the biggest areas of risk is aggregation risk, where and this is likely to gain, a lot of importance. And the nature of conflict so far is characterized by rolling missile and drone attacks across multiple territories over extended periods, raising questions as to whether losses arise from a single event, a series of related events, or multiple occurrences for the purpose of policy limits and deductibles. And where insured damage results from coordinated and geographically dispersed strikes, reinsurers may contend for narrow aggregation. And narrow aggregation, they will consider each of these as separate, incidents, and deductibles will apply for each of them. So the coverage will be lesser for the insured. Cedents and insureds are likely to argue that all these losses form part of a single campaign or operation, and there will be a single deductible, and the kind of coverage would be increased. So there is likely to be a dispute around this. These issues are likely to be heavily wording, fact sensitive, given sums at stake. So, Tommy, would you like to talk about this, aggregation risks, Tommy?
Well, aggregation risk is for the insurers and reinsurers if they have provided war coverages or war-like situation coverages. Then obviously, if there is a claim from a large number of insured, the reinsurers limit would have been reached. But this is usually taken care of, and I am not aware of a large number of people having taken PVT risk or political and violence terrorism risk, which means the current situation, all the insurances insurers are likely to exclude any losses resulting from even a debris falling on a property, on a house, which is not directly affected by the war. So even that also could be excluded, strictly interpreting. And even in health insurance claims and life insurance claims, health insurance claims predominantly, if somebody gets injured and is taken to the hospital, the insurance policy, even the basic insurance policy approved by both the regulators, it does exclude war. War is an exclusion, and it could be excluded. So it most likely we are, we might get a notification or a request from the regulators asking the insurance company to include passive war risk coverages under the health insurance policy, which currently it is not there. So aggregation is a risk, but then reinsurers usually cater to it by strictly monitoring. And that is also the reason why sometimes the reinsurers, when you ask for political violence or war risk coverages, they would come back and say, no, we are already full in this particular country or locality, and we cannot offer any more coverages on that. So it is usually taken care of, Piyush.
Right. Thank you, Tommy. Okay. Also, Iran's threat to close the Strait of Hormuz, together with confirmed attacks on commercial shipping in the Gulf, engage a well-established feature of marine insurance. Ordinary hull and cargo policies deliberately are structured to exclude war and political perils. So, ship owners and charterers trading in high-risk areas typically rely on separate war risk policies to ensure perils excluded from the standard marine cover, including missile and drone attacks, naval mines, seizure and detention. Such war risk policy are normally cancelable on short notice, requiring vessels to leave the designated danger zones within a defined period. In the present circumstances, the multiple cancellation policies have been issued, bringing into focus the interaction between cancellation provisions, vessel movements, and continuing exposure to hostile activity. When vessels are unable to exit the affected area, whether due to port closures, hostilities, or government restrictions, coverage disputes may arise, whether the insured property remains in the grip of peril. Further coverage questions under marine liability and cargo policies are likely. Pollution liabilities, third-party liabilities arising from damage to oil or LNG vessels could be substantial. Cargo interests may face losses arising from delay, detention, or rerouting that fall outside the standard cover. As with other classes of businesses, aggregation and event definitions may prove contentious, as I explained earlier and Tommy explained earlier, where losses arise from multiple attacks occurring over time across a confined but strategically critical trading corridor, the Strait of Hormuz. Which reinsurance lines are exposed most? Standard & Poor's have identified high exposure classes: marine insurance, aviation insurance, energy insurance, political violence and terrorism coverage, cyber insurance, property insurance, supply chain and trade disruption, and marine insurers have already started cancelling war risk coverage for ships operating in part of the Persian Gulf. Tommy, would you like to speak a little more on this? Which reinsurance lines are most exposed?
All the ones, there is a cancellation clause under marine cargo open cover policies, marine P&I policies, charterers liabilities policies, and other marine liability policies, aviation policies. In all these policies, you would find the war cancellation provision, whereby they have to give 7 days notice of cancellation where there is no US-Canada interest involved. But in this case, because of the involvement of US, I think the cancellation notices, they can give 72 hours notice of cancellation. And almost all the P&I clubs have given this notice of cancellation. Similarly, marine cargo insurance, marine cargo insurers, which have covered the war risk, institute war clauses, they would have also given this notice of cancellation, which means that no further shipments are allowed if they are passing through these Iranian waters Gulf of Oman, that area, the particular locality which was given, which shown by Piyush earlier, and it is also notified in terms of GPS coordinates, which all areas, if the vessels go through or cargo is shipped, the war risk coverages will not be there. What is not cancelable is PVT, political violence and terrorism insurance. If there is an existing policy, the standard AFB 1 to 8 coverages under that policy, the insurance company is not allowed to terminate the policy in between before it is expired. So that is the only one where the cancellation provision is specifically removed from the policy, obviously because they are covering the political violence and terrorism. In all other areas, you can give the notice of cancellation.
But Tommy, I just would like to, check with you. Political violence has certain perils. Yes. All of them must be separately covered. Is that right?
Political violence and terrorism cover usually the widest form of PVT cover, which we call AFB, 1 to 8 perils are there. There are 8 perils. One is act of terrorism. Second is sabotage. Third one is SRCC, strikes, riots, and civil commotion. Fourth one is malicious damage. The fifth one is insurrection, revolution, or rebellion. And the sixth one, mutiny or coup d'etat. And seventh one is war or civil war. And the last one, which was added, I think, 7 or 8 years back by PVT underwriters worldwide, was even counterinsurgency. Counterinsurgency means if there is, government of the country are taking measures to act against any terrorism or suspected terrorists or insurgents, so that will also be covered under political violence and terrorism. And these are normally taken in bulk. When you go for a political violence and terrorism insurance, the insureds usually go for all the 8 coverages, perils, or at least the 7 ones. Counterinsurgency is not yet incorporated by many insurers. So the balance 7 are taken invariably when you go for a political violence and terrorism. Otherwise, there are terrorism alone policies. So you can cover just terrorism, and that is also available in the policy. And then there is war on land policies, which is provided in this part of the world by Arab War Reinsurance Syndicate, AVRIS, which is called. And UAE is also a shareholder in AVRIS. Insurance companies, sorry, a lot of insurance companies are shareholders in AVRIS. So if any insurance company which is a member of AVRIS approaches the syndicate for war on land cover, so that is also provided. It is separate from PVT risk. If it is clear, if anybody has got any clarification, as Piyush said, please feel free to raise the query. Now, talking about this marine cargo movements or marine transportation through this Strait of Hormuz, there is a notification or an instruction given by POTUS, President of United States, asking their Development Finance Corporation, United States Development Finance Corporation, to provide at a very reasonable price political risk insurance and guarantees for the financial security of all maritime trade. And here they have also allocated a capital, $20 billion or so, or more than that, into this corporation specifically for this. However, the practicalities and how it is going to be implemented, who all can purchase, and how do we purchase it, that is still not released, or it is not clear to the insurance markets. But you can expect to receive some notification on this shortly if everything goes as as projected or as stated by United States. This is similar to what happened in 2001 when the Twin Towers attack took place, and all of a sudden the reinsurers backed out of giving any terrorism cover at all, and then US government came up with something called TRIA, Terrorism Risk Insurance Authority. So the government had reassured the people by giving coverage for terrorism when the insurance market pulled out because of the huge losses they suffered, So something similar is likely to happen in the current situation also. Anyway, we'll be discussing that in the subsequent slides. Please carry on, Piyush, unless anybody has got any clarification.
Yeah, there are some questions you can answer on the chat box if you can. Or you tell Janita, she will answer.
Yeah, if you can show the question, because I'm not able to see it here.
Yeah.
If you can
We have somebody raising hand also. Sorry, Mr. Piyush. There is somebody who's raised a hand also.
Yeah,
please go ahead.
Good morning, sir.
Morning.
My question is that one of my clients has a marine open cover covering war and SRCC. Okay. So in this global condition, the insurance company had sent a mail saying that they will not continue the coverage for war and SRC. So will it be applicable to the existing open cover policy also, or only for the new shipment?
It is applicable for under the open cover policy. There is a cancellation provision given or incorporated. So you need to see the cancellation provision, which usually states that 7 days notice of cancellation can be given for war risk, and 3 days if US-Canada interest is the notice period is 3 days in case of any US-Canada shipments. So it depends upon the cancellation provision given in the marine open cover policy. Otherwise, the standard cancellation, there is always a 30 days cancellation provision window available. But for war risk, this window is reduced to 7 days in the usual circumstances. But whenever US-Canada is involved, the notice period is reduced further to 3 days.
Okay.
Does that answer?
Okay, sir. But like you mean to say 7 days? I didn't get that point, sir. Sorry.
Yeah, usually there is a 30 days cancellation policy provision in the marine cargo open cover also.
Okay.
But this cancellation notice period is reduced to 7 days for war risk, war and SRCC risk. And the notice period is further reduced to 3 days if US-Canada shipments are involved. Wow. So that is how the cancellation provision is usually incorporated into a marine open cover policy, marine open insurance.
Okay. Okay, sir.
And as I mentioned to you, sir,
yes, sir,
the intention is probably to renegotiate the terms because war risk prices have gone up after that. Second is to tell the concerned ships to move out the area within a specific period of time. So the issue is if they can't move out, then there could be a dispute.
Sir, sir.
No,
yes.
I will clarify one moment. I'll read out one notice period, which is in the actual policy.
Acha, let him speak. Tommy, he has something to say first. Can you speak out?
Yeah, please. But the client is saying that they have already paid the 80% premium in advance, including the VAR and SRCC coverage. So in between the policy, this is the time we want the insurance to be covered. So why you are canceling this VAR and in between the policy?
Yeah,
Because
the
80% advance payment of 80%.
okay. Now the answer to this is in the terms and conditions of the policy, which states one of the way it is worded in the open policy is subject to 30 days cancellation clause for cargo risk, but 7 days cancellation in respect of war and strikes risk, and 48 hours for USA-Canada shipments. So it all depends upon the cancellation provision or the condition given in your open policy. If your open policy does not speak about any cancellation at all, then they would be breaching the policy condition.
Okay.
And if advance premium has been given, there is a provision for refund of the additional premium taken, but then they are only cancelling the war coverage. They are not cancelling other cargo insurances. So other cargo risk. So if the client decides that because you have cancelled the war cover, I do not want to continue with your insurance, please cancel it. In that case, they can claim pro rata refund for the deposit premium given.
Okay, sir.
Okay. So thank you, Tommy. So what is the outlook for the global insurance market? Reinsurance capital remains strong, says S&P, Standard & Poor. They have emphasized that the global reinsurance industry entered 2026 in a position of considerable capital strength. There is capital adequacy provisions applicable to the insurance companies. And there are several factors that support this resilience. Strong underwriting results in recent years, pricing discipline, robust investment income, better risk management frameworks. So S&P expects capital adequacy to remain a core strength for the sector, even under severe geopolitical stress scenarios. The global reinsurance market plays a central role in stabilizing the insurance ecosystem. So S&P's message is clear. Capital strength remains strong and solid. Credit risk appears manageable. Loss volatility may increase in certain specialty lines like war risk. Uncertainty remains high. If the conflict intensifies or expands regionally, there could be further pricing readjustments. Tighter underwriting conditions could follow. So under current assumptions, the reinsurance industry is well positioned to withstand the near-term geopolitical stress. Also, Trump announced, as Tommy also explained, that the Development Finance Corporation will provide guarantees for vessels operating in the area. Also, that the US Navy could escort oil tankers if necessary. Details are not very clear on how DFC, tasked with mobilizing private capital for development projects, reducing investment risks, would structure such coverage. And experts are saying that the proposed guarantees would not be enough to ensure the safe patches of commercial shipping. However, we need to see how it is going to develop. As Tommy mentioned, there could be further notifications around DFC's proposal. Washington also could deploy naval escorts, and this has already happened according to news reports, for oil and gas tankers. Also place them under a US flag, a measure that could be used during the Iran-Iraq war, but the risk of Iranian attacks could still persist. Experts noted that Iran retains several options to target vessels: missiles, naval mines, drones, cyber attacks, underwater strike capabilities. US measures might help bring some degree of stability to oil prices, insurance costs, but the insurance cost to shipping remains high. So what are the key mitigation strategies for insurance and brokers? You have to mull over the policy cancellation and repricing, which Tommy explained in great detail. There could be expansion of excluded areas where ships might be asked to move out of areas which are war-prone. Strategic use of clauses, like cancellation clauses. Also reducing the retention limits, increasing capital limits, restricted coverage scope. Specialized war risks are being carved out of standard policies. So shippers may have to buy separate high-cost coverage. Also, one of the biggest mitigation areas is portfolio diversification. Diversify your investment portfolio, diversify your risk coverage, right, across the world, so that you are not concentrated in only the Gulf coverage. So these are key risk mitigation strategies, ladies and gentlemen. Tommy, will you like to speak about this?
Which one?
The key risk mitigation strategies.
Well, I was telling, as far as mitigation of a war risk or this kind of a political turbulence is concerned, the insured people cannot do much. But for the insurance industry, I would say there is a silver lining in the whole thing. There are huge opportunities for the insurance market.
Tommy, can you just hold on?
Yes.
I'll put that slide up. Your slide. Yes. Go ahead.
Yeah, okay. So, notwithstanding all the negative features that Piyush highlighted, and the threats faced by the industry, this is also a sort of opportunity for insurance. This actually reinforces the old saying that insurance is a handmaid of commerce and trade. So this is the industry, ours is the industry which comes to the rescue of commerce, trade, and business at all times, including at a time like this. Now, in the current situation, the demand for one class of insurance is definitely going to increase, and not only increase, the clients will have to pay increased premium also because of the increased exposure in this region. So the demand for political violence and terrorism, where we are covering all these 8 perils which I stated previously, that has already started increasing, and I'm sure you would have received, many of you would have received inquiries for including political violence in their property policies. Now, because of this incident, the premium for the political violence and terrorism has also gone up. It's unlikely to get a PVT policy for less than 4% or so in UAE at this point of time. I am aware about a Bahrain situated risk where the total insured value is 25 million Bahraini dinar, and with a sum insured with a loss limit of for a loss limit of 10 million Bahraini dinar. The price or the premium charged or quoted by the reinsurer was 1 million Bahraini dinar, nearly 10%. So whether the clients will actually buy or not, that's a $1 million question. So now there are 2-3 possibilities. If the war does not end soon, there is this possibility of US FDC provided political risk insurance, and then coupled with the US and perhaps NATO escort vessels also, they can reassure the maritime traders, and maritime transportation would most likely be reinstated to a reasonable level, even through the Strait of Hormuz. In this situation also, the war risk premium associated with marine cargo, marine hull, and liabilities, including the P&I premiums, will definitely have an increase, record an increase, which means more revenue and more business for insurance industry. Now, when the war ends, it is going to end sooner than later, I hope. There will be massive reconstruction activities happening in this region. So we should expect a boost in the reconstruction activities in the region, which will be accompanied by massive demand for construction insurance and associated insurance, the insurances associated with construction, which means more number of people to be covered under health insurance, more number of people to be covered under personal accident insurance, and all of them will have an element of passive war risk coverages hereafter, because now we have seen that there is an exposure in this region even when the war comes to an end. So post-war, the other silver lining is that very strong likelihood of the sanctions being lifted, which means you will have more business opportunities with Iran without breaching any of the existing sanctions. Not only that, there will be more reinsurance capacities coming from Iran in the form of Iran Reinsurance Company and other insurers currently active in Iran, but who are not able to spread their wings abroad because of the sanctions. So that is also, in my view, a silver lining, where you could find increased business opportunities and consequent to that increased insurance demand. So even after the war is ended, the demand for political violence will definitely be sustained, at least for few years, because now the business people, all of us know that there is an exposure to political risk. So it is better to be insured against the political violence also, rather than simply against the standard PER policies or all risk policies available in the market. So insurance is likely to undergo a boom, in my view, because this is exactly what happened after 2001 also. The demand for terrorism increased, and when the Iraq war ended, there were many business people, even from UAE, who set up operations, including power plants and other facilities in Iraq, and purchased huge amount of construction all risk insurance policies. Not only that, some of these companies who do the reconstruction work in the war-torn countries, they enter into a long-term power purchase agreement or private-public partnership with the government, which means as long as the operations are there under the management or ownership of UAE-based, Dubai-based companies, they will buy insurances for operational risk also from one of the UAE-based insurance companies. So the opportunities are huge. And in the short term, when the reinsurance capacity is drained out or is at a premium, there is also a possibility of the governments coming together to form an insurance pool, or the insurance companies coming together to form a pool for covering the passive war risk and political violence and terrorism. So these are the opportunities and silver linings in the aftermath of this turbulence which we are witnessing today.
Okay, Tommy,
Yeah.
there are some questions that are there.
Yeah.
Let me read them out. Okay.
Yeah, what
The
is the
questions
current?
are,
Is it
One,
given?
I'm
What is the
reading
current
them out.
situation? Okay.
passive war is normally covered, right? This is
Passive
from
war.
Krishnan Venkat Raman.
Okay. Passive war is normally not covered. It has to be specifically mentioned. And it also depends upon the policy. Even in life insurance policies, you have to buy passive war covers, or you have to mention that passive war is insured. Unless it is mentioned in the policy, then passive war risk is not there. What we are currently facing as residents of this country or businesses, we are in a passive war situation. We happen to be in this country when the situation, warlike operations happened. So we are not into, what is strictly excluded is active war risk. Active war risk is strictly excluded unless there are specialist war syndicates who will offer this for a huge price. But otherwise, passive war risk, you have to buy it and specify in the policy. So that is what I was telling. Even in health insurance, currently there is no war risk, including passive war risk. So some of the injuries that the residents have faced, strictly speaking, they may not be covered under the health insurance.
So what you're
basic
saying,
health
Tommy, is
insurance
passive
policy
war risk is not covered.
is not covered.
Okay.
Yeah,
Second
what is-
question, PV policy has to be issued now as a separate policy or can be amended into the existing policy at additional cost in case of PAR. This is from Avinash Naik.
Yeah, the answer is PV risk is to be purchased separately. It is normally given as a separate policy, but you can also add it as an endorsement, but then the insurance company will have to go to the specialized PV underwriter and buy the coverage specifically.
Okay. Is that okay? Avinash Naik, are you satisfied?
Yeah. Perfectly. Yes.
Right.
Thank
Thank you.
you. Yeah.
Andrew Zaki, how has one of the well-known Takaful insurance company announced and offered PV coverage in the current situation? Tommy, would you like to answer that?
Yeah. The answer is simple. They would have purchased a reinsurance contract or a treaty for covering this, but the prices quoted by them are likely to be not the usual, not the pre-28 February prices that were available in the market. So PV coverage is still available. As I told you, PV coverage is available in the UAE and other GCC countries, but the price will be high.
Yeah.
But I doubt whether somebody would have been given an automatic treaty facilities. So the difference between a treaty and a line slip facility or a pre-underwritten facility will be in a treaty, the cedents, insurance companies are free to quote their own prices, terms and conditions. subject to the overall treaty provisions. But in a separate facility, the prices will be determined by the reinsurers or specialist underwriters. So
Okay, is that
the
okay,
difference.
Andrew Zaki? Hello, Andrew.
Information. Perfect.
Okay. Okay. We are supposed to close by 12:20. Now it's 12:15, so we have another 5 minutes more. So let's continue. Okay, what is the current situation is characterized by insurers as far as no war is declared? I think that is an issue about Sajad Salim. It's about passive war. Passive war is also not covered. So I take it as that way.
Yeah.
So Raghuraj Raju, thanks for the insightful information. My question is, impact of delayed stalled shipments on companies resulting in business interruption claims. BI excludes damages from war or missile strike. Does the delayed shipments are applicable under BI? Tommy, would you like to answer?
Yeah, delay the marine shipments. Marine is covered by the Institute war clauses, and delay is excluded. So any consequences of delay, even if the delay is caused by one of the insured perils, is excluded, unless you have obtained a contamination insurance or a cargo rejection insurance, where because of the delay the cargo is contaminated and the whole cargo is rejected by the buyer or the government in the country, because especially the frozen cargo and food, meat, etc., which is dispatched, and when it reaches after some delay because of war or any other reason, it is contaminated and cannot be used, and the government or the department there, customs department, they decline to accept this or let the goods enter the country. And sometimes you are also obliged to destroy this cargo which is contaminated. So this is covered only when you have a cargo rejection insurance specifically. Otherwise, delay itself is not covered.
Yeah, in fact, I mentioned in my presentation, no damage, business interruption may not be covered. This is what I covered. Right, Tommy?
Yeah. The business interruption is also subject to the war risk exclusion.
Okay. So I hope that is okay. Raghuraj Raju, are you satisfied? Raghuraj Raju? Okay, it seems he's not there. Okay. Krishnan Venkataraman. War coverage cancellation is currently limited to West Asia region. Rest of world cover still exists? Tommy, would you like to answer?
Oh, yes. Rest of the world cover exists. This is as far as marine cargo and marine hull and P&I insurances are concerned. But if anybody has given a cancellation notice for war on land, if there is a cancellation provision, that insurers will be valid to cancel the cover wherever the risk is situated. But otherwise, movement across these particular areas are restricted, and it also depends upon the notice of cancellation received or sent by the underwriter. If the underwriter says because of the ongoing situation they are removing the war cover, absolutely they have a right to do that under the notice of cancellation. Some notice of cancellation will say any movement, especially in the hull and machinery, they will say movement of vessels and cargo through this particular area, Iranian waters. The exact, you would have seen in the notice of cancellation, the exact area is determined there. So that particular one is cancelled.
Okay, are you satisfied, Krishnan? Okay, Vinay, we have covered 12:20, so we will close the session here. And, whatever the questions that have been asked, we will reply. We will pass on that information to you. Is that okay, Vinay?
Perfect, Mr. Bijosh. That's fine.
Yeah.
Fine. So I would now like to invite our Chief Distribution Officer for QIC, Mr. Subi, to address the group. Over to you.
Thank you, Vinay. Thank you, Vinay, and then special thanks to all of you who participated. I would like to thank our co-organizers, Crowe, especially Mr. Pierce, Tony, and Manoj for their support in definitely making this event. I feel it is very successful. The insights were very useful. Thanks to Crowe and team. And definitely thanks to the entire broker fraternity. I think they joined, and I can see in excess of 300 attendees today. That really makes us happy that I think the communication and the event went on very well. We look forward at QIC to hosting many such events in future. And then finally, before I close it, I would want to wish everyone very a big safety and well-being, and stay safe to all of you. And finally, thanks to Vinay and our team at QIC who organized this. Have a great day ahead and stay safe. Thank you.
Thank you, Mr. Subramani.
Thank you. Thanks a lot, sir. We'll catch up soon.
Thank you. Thank you.
Thanks a lot.
So goodbye, everyone. Thank you, Vinay. Thank you, Tommy. Thank you, Mr. Subramaniam. Thanks a lot. Thank you, Manoj.